Bloomberg Audio Studios.
Podcasts, radio, news.
The CFO of Wells Fargo joins us now on Bloomberg. Mike Santomassimo, great to see you once again here. A relatively upbeat quarter, at least based on the reaction that we've seen out of investors and also by some of the comments that you and Charlie Scharf made on that conference call about the resiliency of the consumer. Can you expand on that a little bit more, Mike? What exactly are you seeing?
Yeah, well, first, thanks for having me again. And as you saw in the results of the quarter, the consumer has been quite resilient actually now for the last number of quarters. And I think you can see that in the activity levels, you can see that in the credit performance in the quarter, and you can see that in the underlying deposit franchise as well, as you were just mentioning. And so when you look just more broadly at the results, it's not just the consumer side, it's the commercial side as well. We saw good growth across most of the businesses in the fee side. We saw an expected decline in net interest income, but we feel like we're likely at the trough of the NII trend at this point. So there's a lot of good things underneath that underpin what you saw in the quarter.
Is there a sense, when you talk about the trough potentially that we are, is that largely a function of the move that we've seen in Fed rates, or is there something more to that?
Well, I think the reduction in rates does help, right? Because we've been able to adjust client pricing as a result of that. But you're also still seeing, rates are still quite high on a relative basis from the last few years, and so you are still seeing repricing happen on the asset side. But in the near term, what really drive where we end up over the next couple of quarters is the deposit side, and we've seen some good trends there now over the last couple of quarters, where you've seen this cash sorting and the different mix changes really moderate. It was the slowest quarter where, so far since over the last couple of years, for that in the portfolio, and we've been able to adjust pricing just as we thought we would as the rates came down. So that'll be the factor that really drives the near-term performance.
So, Mike, it's good to chat with you. To that point, then, does that mean that the move into higher yielding, say, CDs or money market funds, et cetera, that's definitely done as rates cuts come down?
Well, I wouldn't say it's necessarily done, but I think we saw the lowest pace of migration since rates started increasing, Alix. And so I think that's a good trend. And I think eventually what you see generally, or expect to see generally, is that what's left in checking accounts ends up being operating cash for a lot of people. So a lot of that shifting into other alternatives has happened already.
Yeah, my high yield savings account already coming down there. All right, let's get to the loan part of your portfolio. When do you think you see a really big uptick in loan growth? What's going to be that catalyst?
Yeah, it's really hard to say exactly, right? And I think when you look at what we're hearing from clients and what you're seeing, rates coming down, helpful, right? Because borrowing costs come down. I think there's still some uncertainty related to the election that's coming up. And then I think people want to see this base case kind of soft landing economic scenario play out a little bit longer. And then I think a combination of those things will start to build confidence. And then I think you may start to see people either build inventories or make additional capital expenditures that they've been holding off on now for a little bit. But I don't think it's just one thing. I think you really need to see a confluence of these things come together, and so it could take a little bit of time for that to really materialize in borrowing.
With regards to that client activity, Mike, and the election, and the idea that once we get past that, maybe we see more activity, is that irrespective of who wins, or are they trying to hedge their bets?
Well, I think what people don't like is uncertainty, Romaine, and so I think once there's some certainty of the path, and you feel like that economic outlook is going to play out the way they think, I think those things are going to what really matter, and then assuming rates continue to come down and reduce borrowing costs. So I really do think it's going to be a combination of all those things, but it's the uncertainty part that I think causes people to hold off.
I do want to ask you about some of the regulatory issues that continue to hang over Wells Fargo. Last month, Bloomberg did report that you had actually entered a new phase here to get out from under that Fed's asset cap. I am curious as to the progress that you've made in moving in that direction, and whether you are anticipating that cap to be removed soon.
Yeah, I mean, as always, my answer might be a little unfulfilling, Romaine, but I think we continue to very much focus on getting the work done that we have there, and ultimately it's going to be up to the Fed to decide when they're ready to do that. But we continue to feel like we're making really good progress. We're confident we're going to get through it, but ultimately it's going to be up to the Fed to decide the ultimate outcome there.
It definitely has to be Mike's favorite question, I think, when it comes to earnings interviews. But what kind of spend profile do you think you're going to have once that asset cap is removed? Like, are we going to be like, all right, let's invest a bunch of money, or how's the plan sorting itself out?
No, it doesn't change the strategy that we've been, executing on now for the last number of years. Like, we are already making the investments we need to make into the businesses to grow them over a long period of time, and we're paying for that through the efficiency program that we've executed now for the last, 4 or 5 years. And I think we still very much feel, and I think Charlie talked about it on the call this morning, we very much feel like there's a lot more opportunity for us to drive more efficiency, and that'll allow us to continue to make the investments we need to make in each of the businesses, and we're going to keep doing what we've been doing now for the last 4 or 5 years.
We talked about the election in terms of the demand profile. What about your client activity in trading, for example? Like, how are your clients positioned? How are they thinking about the next few weeks?
Well, I think most people are probably hedging their bets a little bit, right, and making sure they're not taking too much risk going into what can be an uncertain environment. But volatility, as you know, can sometimes create opportunity for folks, and I think that certainly creates opportunity in a trading business like ours and others. And so we'll see how it plays out. But I think going in, we're going into this next month or so pretty cautiously as we sort of think about the risk we have in the trading side.
We haven't had a chance to really ask you about the state of the commercial real estate market, at least as it relates here to the business that Wells Fargo does. You clearly have some insights into that, Mike, and I am curious as to whether you've seen anything resembling a trough in what has been ailing that space, particularly in the office space.
Yeah, well, I think broadly commercial real estate's doing quite well. It's really an office story, where you see the most stress, and so I think in the other asset classes, you continue to see a lot of activity. You can see the CMBS market, securitization market, pretty active in other asset classes like multifamily. So really, that stress is in the office space. And it's really going to take some time to play out. We're not quite done working through, those issues, and it's hard to call whether it's at a trough or a bottom, in that market at this point. And it's still the same trends, though, that we're seeing. Newer buildings in the right places are doing just fine. Older buildings are not doing fine. It's pretty consistent across the U.S., and it's going to take a while to play out. It's not going to be done in the next quarter or two. And for us, we've got a high allowance for coverage, coverage ratio in the credit book there in those institutional office properties. So we're really prepared for it, and it's for the most part, I'd say, kind of within the expectations that we had for it. But it's still not quite turning yet in terms of getting better for the properties that are most stressed.
Hey, Mike, we really appreciate it. It was fun to get your time today. Thank you so much. We'll get you in the next quarter. Mike Santomassimo, CFO over at Wells Fargo.